Hey traders, welcome to Charts and Coffee. Happy Thursday, everybody. Hope everyone's doing well. All right, so we have the aftermath right now of the initial claims and GDP. So quite a bit of macroeconomic data for the market to process. Of course, there are specific pillars of macroeconomics that map to on a rate of change basis. In other words, what's the trend of the data? Release after release after release. And right now we're dealing with the Federal Reserve trying to, of course, inflation, growth, jobs. And so any of the releases, those particular hot zones on those particular points of the economy are going to be potential needle movers. And so we take a look at the time of the release. What was the reaction? Bullish, bearish. And I get a question quite often, which is, Rog, are we in that time of good news is bad news? And anytime we're dealing with the Federal Reserve shifting monetary policy, messaging the shifts about, monetary policy that's different than what preceded, yes, the answer is yes. Data that's now, it's not just a simple good is bad, but what is the context? So inflation numbers that are higher keep the Federal Reserve on their current fairly aggressive path. Less high, neutral, lower, that's definitely going to signal to the market a shift to come in the messaging and the policy from the Federal Reserve. So those are the things that we look at. Growth, of course, jobs, of course. So we're in interesting times, no doubt. And in interesting times, as many of you know, and I talk about this every summer, because if it isn't just the general illiquidity, it's the volatility. It's the, are we in a downtrend or not? What kind of volatility are we dealing with? Is this risk appetite or risk aversion or what? And any kind of confusion is what leads to the lack of follow through. And as traders, our lifeblood is follow through. We get an idea, we buy or short at X, and we want to see the market then move off that level. So the easiest way to deal with the uncertainty is just demand from our trades and our setups and demand from the market, less time in organization. And that's really what day trading is about. So as we go into June, that's a lot more of what I tend to do. And I'm pretty glad that that's where, the direction's pointing, because the confusion leads to better day trading, and the confusion leads to day trading being a better choice. So that's where I sit right now. There's still a good bit of organization in this market, though, gang. Let me just mention that there still are trends. Indices are still in a downtrend, and actually, take a look at the Dow here. It's correcting to the 21 propulsion. Take a look at the S&P here, still sitting around the 13. Take a look at the NASDAQ. It's the weakest by a landslide of these. Take a look at the long bond. Was in a downtrend, now it's in neutral. The question I often get is, Rog, what's next? Well, of course, this could have a 1, 2, 3 reversal, no doubt. In fact, it is a valid consideration, of course, but the higher probability is continuation and respecting the trend that was. So that's the 30-year. This is the 10-year. Same idea. The 10-year is a little bit more froggy. A lot of this, I believe, is coming from the timing aspect of the news from China. The China economic data has been, and really economic messaging has been lighting a fire under the 10-year. But there are certain trends, gang, that continue to look really solid. RBOB gasoline, natural gas. Yes, I do believe the US dollar is still something that's likely to continue to trend higher. It'll continue from this neutral pullback. So lots to like. Lots to like. But let's go ahead and jump into the question. First up is Silver Mamba looking to buy puts on HYG, ITB, XHB. Yes, I probably would say ITB is good, but it's a little choppy. XHB, probably a little bit better. But here's what I'll tell you with this one, and I'm talking my book here, so I just want to make sure I'm perfectly clear on this. Um, DHI. So when you crack open the stocks that are within ITB XHB, you'll notice that there are some downtrends. I believe Lowe's is one of them. DHI is another. DHI is far more affordable. So you might want to go with a boat over the tide when you're looking at this. And another way to look at this is to consider, well, what is the tide doing? In this case, the tide would be, say, XHB or ITB, which is the home builders. And you compare the structure of the tide to the boat. The boat's double red. The tide's kind of going back and forth between yellow and red. So it's bearish. It's bearish, but it's not set in the same way the downtrend in DHI is. So thanks for the question. JB, longtime listener, thank you very much. Could I please re-explain the S&P clearing range trade I explained a long time ago? So JB, the first part of your question is the range. Yes, the range. Now that range, so JB, anything that I teach that has volatility as a factor, as say the clearing range would, right? That's always changing because volatility is always a fluid thing. So for the same reason that it's not a fixed, as you mentioned, 17 points, it's going to be different now. It's going to be different. It could be less. It could be more based on the current volatility between 9 and 10 a.m. The same thing applies to my HPMRs. Those are constantly going to be in fluctuation, not necessarily intraday or not even day to day, but every couple of weeks, we're going to have to look at the cumulative shifts, either contraction or expansion of that volatility. And the HPMRs, this indicator of mine, have to be recalculated based on the volatility that's occurring at a specific hour of the day. Same thing occurs with that clearing range. That number is going to change. It's higher now. It's far higher now. And then as far as the high-low range, yeah, I'm just looking for a breakout of the high to low range. And JB, I do this every morning with either the group in the Sector Secrets Mastery or the Futures Room if you ever want to watch me do it live. But yeah, then we're watching the high-low range. Now, it's not as simple as long above, short below. I mean, there's a lot of nuance that we can consider. What's the directional bias of the day, right? This line in the sand. Do I want to play a breach momentum or do I want to play a retreat? The retreat's less expensive by way of, if you want to play options, it's lower risk by way of the chasm between the entry and the stop. So there's little decisions like that to be made. But yes, it's pretty much a fairly mechanical setup. And we have an indicator that automates a lot of this process for us. So that's really what I'm looking at. And yes, the breach, to your point, your last point there, must trigger before 10:30. Correct. All right, next up, Michael, can I please explain how 10 and 30-year bond interest rates affect macro market direction? Well, the macroeconomic data is going to affect those, not necessarily the other way around. So traders my take on that is traders in the 10-year and in the 30-year are looking at, of course, where interest rates could, may be heading. Now, one way to visualize rates is to look at the TNX and see that the TNX has been in an uptrend. Now, this is the actual yield. So you'll notice this isn't an uptrend, but IEF or the ZN, which are the ETF and futures respectively of the 10-year note, they're in a downtrend. So yes, as the futures contract or the ETF go lower, the yields are actually going higher. So a lot of this is going to have to do with whether or not traders are compelled to be buying the notes, and buying the notes brings the yield down, or shorting the notes. They don't want them, or they want a short position in them, and then the yields go up. So those decisions are going to be made by messaging from the Federal Reserve. If you take a look at some of the messaging China has made about the Chinese economy lately, you will notice that's about the time that the 10-year got pretty froggy, up and green. And that's where the 10-year, much like the way the US dollar had to recalibrate, had to rediscount what what it knew about Christine Lagarde and the ECB's plan with the euro and to come out of negative deposit rates. Those are all macroeconomic pillars that then map to the dollar or map to notes. So that's the way I look at it, Michael. I don't know that it's a right or wrong thing, but if expectations are for higher rates, dollar should continue in that bullish direction, and bonds and notes should continue in that bearish direction. So that's the correlation that I look at. All right. So thanks as always for the question. All right. Next up, let's take a look at the economic calendar because I think that's the next question. And let's take a look at the calendar. Yeah, let's do that right now. So today we have preliminary GDP, pending home sales at 10. Not that I'm overlooking that. We've got PCE tomorrow. So the question is, what are my thoughts? Well, William, my thoughts are always this. It's a hot zone. So my thought is it's going to be a high impact, high volatility scheduled economic event. I don't front run them. I don't try to position according to what I think they're going to be. I don't trade the event. So those are my thoughts. My thought is it's going to be a catalyst for volatility. That catalyst could propel my trades to their target. It could propel my trades to their stop loss, or it could propel price to levels that I want to engage the markets. We have a number of alerts right now that need a little bit of volatility to get reached. In other words, no trigger, no price trigger, no trade entry, right? No order entry. And ultimately, what we want to remember is that we can use the volatility. We don't want to try to put in ourselves in a situation where we have to predict it. So let the volatility be a part of the process, but let's not say, well, I think PCE is going to be this, so I'm going to put in a position to capitalize on that vol. It's tempting, right? I do the same thing with earnings. Don't guess at which way they're going to go. Just presume they're going to be a volatility event and try to take advantage of the move sort of after the volatility kicks in and see where it carries price and whether or not that level is useful. So thanks for the question. All right, moving on to BX. All right, BX. And I'm on the trading view charts today because I've been spending an awful lot of time on Thinkorswim. So I thought, you know what, let's give some trading view charts some love today. I do love these charts. They're great charts. So BX, double red. It's going a little bit more yellow. Is it a 1, 2, 3? Yeah, I would. So yes, I would consider 1, 2, 3. But here's the challenge for BX. So there's your 1, 2, 3 at the Darvis break. But here's a challenge right there. So yes, you could look at the breakout, but I had a similar issue on bonds and I think notes where, yeah, there's a 1, 2, 3, and I've got the prerequisite of the neutral market. If you're not familiar with the 1, 2, 3 pattern, what you're really talking about, to think about it a little bit more fully, is you want an overall move lower, right? You want the pattern to start to develop. And then as the pattern's breaking out, you want the market to have shifted to more of a neutral environment. That's a 1, 2, 3. This is a Dow 1, 2, 3 pattern. This is a centuries old pattern. You can call it whatever you want, but I like to give credit where credit is due. This is a Dow 1, 2, 3. So yes, the requisite of the neutral market is there, but follow through is very much, especially for a question about where is resistance parked. And if I have a Darvis nearby or a 200 propulsion, 200 exponential nearby, the upside is fairly limited. And I may choose not to take that trade on the break. And I may choose, imagine this. What if we continue to kind of move in a way that, let's just do this again. Let me give you an idea. So downtrend, 1, 2, 3 pattern. What if we just kind of continue to move like this, and then we retest a level, all the while that neutral market trend continues? It doesn't hurt to sometimes think about, well, let that neutral market continue, because what that neutral market does is it discourages bears and it encourages bulls. And there's a better, oftentimes, chance, not always, sometimes the 1, 2, 3 happens and it's gone. But especially with a 200 overhead, it won't hurt to see if the market can't collect itself and make another run at the break. So those are things I think about with a Dow 1, 2, 3. And yes, Mark, good eye. Just be careful about that 200 overhead. All right. Gordon asks, where do I go to learn all the indicators that work together to signal different levels of entry, agro, moderate, conservative? Gordon, you come to where I teach this each and every day. You can do a couple things, right? Of course, if you want to come join me at the Sector Secrets Mastery or in the Simpler Futures Room, hopefully that's an obvious thing for those of you that are not members and you dig the analysis and you want to know more about these tools and trades. Yeah, come join me at Sector Secrets. If you still just are in the learning process, you say, Rag, I'm not quite ready. That's cool too. Head on over to countdowntrader.com. Trish keeps an unbelievable blog there of my tools, my processes, and we have updates, consistent video and text updates over at countdowntrader.com. So Gordon, either come join the community over at Sector Secrets Mastery or Simpler Futures, or check out Countdown Trader. Either way, you won't be disappointed. All right, next up is Ray, who asks, jobless claims, basically the same, but people still feel pain at grocery store and gas pumps among other areas, and we are bullish, not falling for it. Yeah, I don't know, Ray. Here's what I'll tell you. When you say bullish, I don't know what you mean. We are bullish, but you bring up a point of the way in which data is processed. What's our opinion of this? We never want to presume the opinion. We, remember the good or bad, the hit or the miss, the higher or the lower number. We really want to let the market, and we want to react to it. We want to let the market decide. We're in a downtrend. So to your point, my expectation is still that the path of least resistance is lower. This is the daily time frame on the right side here. This is the 5-minute with my intraday tools on the left. I don't mind to be a bull intraday. I don't mind to just play the short-term windows of opportunity on a 5-minute time frame. But longer term, we have still a lot of bearishness. Yeah, no doubt. Still have a lot of bearishness. All right. So William asks, there are many inflation indices. I get confused about the impact. Well, there's two, CPI and PCE. That's what I look at the most. PCE is generally perceived to be sort of the pet inflation number of the FOMC, but watch them both. But CPI and PCE are the main ones you need to keep an eye on. All right. Stern asks, would I please describe what kind of investor I am? So investor, well, the only place I talk about my investing portfolio is once a quarter and in between alerts and macroeconomic videos that I send out weekly in the Sector Secrets Mastery. So the kind of investor that I am, I'm not a value investor. What I am is what a trader would be if they applied their skills to a weekly time frame. So I really consider most of my investments just a very long duration, long time horizon position trade. Because at the end of the day, the real difference between investors and traders is this. Investors are looking to continually grow their ownership of an ETF or a stock or what have you. Traders are looking for the price movement differentials. I want to think about it from a trader's perspective, which is marrying the patience of an investor with the timing and the understanding of technicals and sector rotation that I think is a little bit more of a trader's skill set. So if that resonates with you, if you're thinking about, okay, Rod, That's what you do in the room. That's how you think about it. If what I just said resonates with you, that's exactly what we do in the mastery. So I take what I am as a trader and I apply the patience and really some of the portfolio type construction management of an investor. But it's really a hybrid. It's really a hybrid approach. And it's a little bit more active. It's not set it and forget it. So if that resonates, if that little brief explainer resonates with you, that is what I do. And yes, we day trade in the Sector Secrets Mastery. The core of it, of course, is the daily time frame swing trades. And now we've gone to the longer term time horizon because, look, I think the members really want that full approach. They want to say, okay, Rog, how do I handle intraday? How do I take advantage of the core of what I want to do, which is daily time frame trend following? But then how do I also take what I'm learning and apply it to my longer term portfolios? So I'm here to just share with everybody the way that I process it. And that's hopefully gives you a glimpse of the way the gears in this brain turn. So thank you for the question. And as always, gang, thank you for being here for Charts and Coffee. Boy, that 20 minutes goes quick. I'm going to go hop into the futures room for some day trading this morning. And I will see all of you, hopefully, tomorrow, not only for Charts and Coffee between 9 and 9:20 Eastern, but also for our big Simpler Circle event. So if you are a member, you're probably going to get to meet some traders here at Simpler that you may not always have a chance to sit in on their sessions. And if you're not a member, come check it out. Come see what we're doing. And you get a great cross section of what it is that we do here as traders at Simpler. So really excited for that. So as always, though, I'll see y'all for Charts and Coffee tomorrow. Caffeinate and dominate, gang. Be good to each other.